When most investors think about systemic risk, they look to the stock market. They observe volatility, sharp declines, banking crises. But historically, major financial events don't begin in the stock market. They begin in the bond market. The bond market is the circulatory system of the global financial system. It determines the cost of capital. It prices sovereign risk. It defines the discount used to value virtually all financial assets. And right now, it's sending clear signals of structural tension. I'm not talking about short-term movements. I'm not talking about weekly volatility. I'm talking about changes in the structure of the U.S. yield curve, specifically in the dynamics between short-term rates, long-term rates, and the term premium. Throughout history, before significant crises, be it the tech bubble in the early 2000s or the 2008 financial crisis, the bond market has begun to behave atypically months, sometimes years before the main event. What we are observing now is not identical to the past, but there are structural parallels that deserve attention. American public debt has grown exponentially in recent decades. For a long time, this growth was masked by structurally low interest rates. The average cost of debt seemed manageable. The dominant narrative was simple: as long as interest rates remain low, the debt is sustainable. But monetary regimes change, and when the regime changes, the math changes. Today, the Federal Reserve operates in an environment of higher interest rates than the average of the last decade. The government continues to issue debt in significant volumes, and the structural base of buyers is transforming. These three elements, higher costs, increased issuance, and changing demand, create a scenario where the yield curve begins to reflect fiscal risk more explicitly. What I will show throughout this content are three specific signals in the bond market that, when analyzed together, point to a possible disruption in the trajectory of U.S. debt by 2026. This is not a dramatic prediction. It is a technical interpretation. The bond market doesn't scream, it adjusts slowly, and when the adjustment becomes too visible, it's usually too late to react strategically. Therefore, understanding these signals now is not optional for anyone who wants to protect their assets. It's essential. We've established that the bond market is sending signals of tension. Now we need to understand the structural basis of this movement, the trajectory of U.S. public debt. The central point is not the absolute number of debts. The number is large, but size alone does not determine collapse. What determines instability is the relationship between debt growth, nominal GDP growth, and the average cost of financing. The United States has been operating with recurring fiscal deficits for decades. Even during periods of economic expansion, the budget remains structurally negative. This means that debt growth is not just a consequence of recessions, it is part of the fiscal model. For a long time, this model was sustained by two main factors: reasonable nominal growth and extremely low interest rates. This second factor was decisive. After the 2008 crisis, the Federal Reserve implemented large-scale quantitative easing policies. The massive purchase of treasuries artificially compressed long-term yields. The average cost of federal debt fell significantly. This created the perception that the debt was manageable indefinitely. But there is a fundamental difference between stock and flow. The debt stock may appear stable, while the average cost is low. However, the cash flow, that is the ongoing refinancing, depends on the rates prevailing at the time of rollover. And here's the critical point: a significant portion of the debt issued in a near-zero interest rate environment matures between now and 2026. This means it will need to be refinanced at much higher rates than those originally contracted. If the average cost rises 2 or 3 percentage points on a trillion-dollar base, the fiscal impact is not linear, it is exponential. Interest payments begin to compete with other major items in the federal budget, and when debt servicing grows faster than revenue, sustainability is questioned not for ideological reasons, but for mathematical ones. Furthermore, the debt-to-GDP ratio only stabilizes if nominal growth exceeds the average cost of debt. In an environment of economic slowdown and higher interest rates, this condition becomes difficult to maintain. Therefore, what we have is a sensitive equation: increasing debt, a constant need for refinancing, and a structurally higher interest rate regime than in the previous decade. This is the fundamental principle. Now that we understand the structural trajectory of the debt, we need to observe where the market begins to reflect this pressure. The first sign is in the long end of the yield curve, especially in 10 and 30-year treasuries. For more than a decade, long-term yields remained artificially compressed. This was not an organic market phenomenon. It was a direct result of the balance sheet expansion policies pursued by the Federal Reserve. When the Fed bought bonds on a large scale, it reduced the so-called term premium, the premium investors demanded to bear long-term risk. At many points, this premium became negative. This means that investors accepted lower yields than the historical risk would justify. This environment created a psychological anchor, the belief that long-term interest rates would always return to low levels after any monetary tightening cycle. But the regime has changed. Today, the Fed is not expanding its balance sheet, it is shrinking it. The so-called quantitative tightening implies a structural withdrawal of liquidity from the system. The largest marginal buyer of treasuries is no longer supporting prices. At the same time, the volume of Treasury issuance has increased to finance persistent deficits. When supply increases and the structural buyer exits, the market needs to rebalance, and this rebalancing occurs via price. In fixed income, a lower price means a higher yield. What we are observing is the reemergence of a positive and growing term premium. This is fundamental because when the maturity premium rises structurally, it ceases to reflect only short-term inflation expectations. It begins to reflect fiscal risk, sustainability risk, and uncertainty about future monetary policy. Another important element is the relative reduction in foreign participation in the absorption of treasuries. Countries that historically were large net buyers have begun to diversify reserves or reduce the pace of accumulation. This means that a larger portion of the issuance needs to be absorbed by domestic private investors, and private investors demand adequate compensation. The unanchoring of the long end is not just a temporary rise in yields, it's a change in the pricing mechanism of American sovereign risk. If this trend persists, the average cost of federal debt will begin to rise consistently as bonds are refinanced. And when long-term interest rates rise for structural and not just cyclical reasons, the implication is far more profound. That's the first sign. Now we need to move from theory to the operational mechanics of debt. The United States government doesn't pay its debt in full. It rolls it over. When a bond matures, the Treasury issues another to replace the previous one. This process is continuous, predictable, and structural. The problem arises when the interest rate environment changes significantly between the time of the original issuance and the time of refinancing. During the decade following the 2008 financial crisis, the Federal Reserve kept interest rates near zero for an extended period. The Treasury issued significant amounts of debt in this environment. The average cost fell. Debt servicing became relatively comfortable in historical terms. But the public debt is a dynamic asset. It has a maturity date, and the maturity schedule up to 2026 is particularly relevant because it concentrates a significant portion of bonds issued in an environment of exceptionally low interest rates. As these bonds mature, they need to be replaced by new issuances at prevailing rates. If the current market rate is 2, 3, or even 4 percentage points higher than the original rate, the impact on the annual interest payment is immediate. This impact is not gradual in the traditional sense. It accumulates rapidly because it occurs on a trillion-dollar base. Imagine an average 2% increase applied to trillions of dollars, refinanced. We're talking about hundreds of billions more in interest payments over just a few years. This alters the composition of the federal budget. Debt servicing begins to compete directly with mandatory expenses such as Social Security, healthcare, and defense. When interest payments start to occupy an increasing share of revenue, fiscal flexibility decreases. And here's a critical point. Markets don't just react to current figures, they react to the projected trajectory. If investors realize that, if current rates are maintained, the cost of debt will increase rapidly until 2026, they adjust the premium demanded today. This creates a circular effect. Higher rates increase the future cost. The projected increase in the future cost raises the premium demanded today. The higher premium keeps rates high. This dynamic is particularly sensitive when the primary deficit remains high because it means the government continues to issue more than necessary for rollover. Therefore, 2026 is not an arbitrary number. It represents a potential inflection point where the full impact of the new interest rate regime will be reflected in the average cost of debt. Now we come to the second structural signal, and perhaps the most underestimated by the average investor, the trajectory of debt servicing as a percentage of federal revenue. Until recently, interest payments were manageable, not because the debt was small, but because the average cost was artificially low. This detail made all the difference. When the Federal Reserve kept interest rates near zero for an extended period, the Treasury was able to lengthen maturities and reduce the average cost of debt. The system appeared stable. But stability based on abnormally low interest rates is not structural, it is circumstantial. As the interest rate regime changed, debt servicing began to rise rapidly. And here's the key point. What matters is not just the absolute amount paid in interest, but the proportion of that amount relative to government revenue. If revenue grows at a slower rate than the cost of debt grows, fiscal space shrinks. When interest payments begin to consume an increasing share of tax revenue, the government has less flexibility for public policies, less room to respond to crises, and less capacity for economic stabilization. This is the moment when the market begins to reassess sovereign risk. Historically, countries do not enter a crisis when debt is high. They enter a crisis when the cost of financing that debt becomes disproportionate to the capacity to collect revenue. And there is another relevant element, the primary deficit. If the government is already operating at a deficit before considering interest payments, any increase in the cost of debt amplifies the need for additional issuance. This creates a feedback loop. More debt generates more interest generates more issuance demands a higher market premium. The bond market observes this progression with mathematical precision. When investors realize that the debt service trajectory is accelerating, they adjust the term premium, not out of panic, but due to risk calculation. This is the second signal. It's not an isolated event. It's a structural trend that could reach a critical point when refinancing at higher rates consolidates by 2026. Now we come to the third signal. This one is more technical, but historically it is one of the most reliable indicators of financial disruption, the dynamics of the yield curve after a prolonged inversion. A yield curve inversion occurs when short-term rates rise above long-term rates. Under normal conditions, investors demand higher yields to borrow for longer periods. When this inverts, the market is signaling expectations of economic slowdown and future interest rate cuts. Virtually all modern recessions have been preceded by significant inversions of the American yield curve. But the critical point is not just the inversion, it's what happens afterward. Historically, major stress events occur when the curve ceases to be inverted and begins to steepen rapidly again, the so-called steepening. And there are two types of steepening, benign and adverse. The benign scenario occurs when the economy accelerates and long-term interest rates rise due to healthy growth. The adverse scenario, which interests us here, occurs when short-term interest rates fall due to economic weakening while long-term interest rates rise due to an increase in the fiscal risk premium. This movement is known as bear steepening. This scenario is particularly dangerous. Imagine the following scenario up to 2025 or 2026. The economy slows down after a period of monetary tightening. The Federal Reserve begins cutting short-term interest rates. At the same time, investors demand a higher premium to finance growing deficits and expanding debt. Result: short-term rates fall, long-term rates remain high or rise. This movement puts pressure on multiple factors simultaneously. First, the cost of government financing remains high on the long end of the curve. Second, the banking system is suffering from margin compression and devaluation of long-duration assets. Third, valuations of financial assets remain pressured by a structurally high discount rate. Furthermore, in a slowdown environment, fiscal deficits tend to increase automatically due to a drop in revenue and an increase in social spending. This implies more issuance precisely when the market is already demanding a higher premium. This combination creates a risk of instability in the Treasury market, the asset considered the foundation of the entire global financial system. When the yield curve shifts from deeply inverted to rapidly steepening under fiscal pressure, we are facing a historic sign of systemic tension. That is the third signal. Now we need to connect the three signals. In isolation, each can be interpreted as a natural part of an economic cycle, but systemic markets rarely experience stress due to a single factor. What generates disruption is convergence. To summarize objectively, first, we observe the unanchoring of the long end of the yield curve. The term premium has returned to positive territory and is increasing, reflecting not only inflation but also fiscal risk and a structural shift in the demand for treasuries. Second, the debt service trajectory is accelerating as a percentage of federal revenue. Refinancing at higher rates is transforming interest payments into one of the main budget expenditures. Third, we have a deep inversion of the yield curve that could evolve into an adverse steepening if the economy slows while the fiscal risk premium remains high. When these three vectors align, the system enters a sensitive zone. The central point is this: the bond market operates based on confidence. Confidence in the ability to pay, in monetary stability, and in long-term fiscal discipline. As long as this confidence remains intact, even high levels of debt can be managed. But when the trajectory begins to suggest structural deterioration, the adjustment occurs via pricing rapidly. By 2026, much of the debt issued during the ultra-low interest rate regime will have been refinanced. This means that the full impact of the new rate environment will be reflected in the average cost of federal debt. If, at this point, nominal growth is not robust enough to offset the increased cost of financing, the debt-to-GDP ratio could enter an unfavorable dynamic. Furthermore, fiscal policy in the United States faces significant polarization. Structural adjustments require consensus, and consensus is scarce in a fragmented political environment. The market does not expect a perfect political resolution. It prices in probability. If the probability of an unsustainable fiscal trajectory increases, the required premium increases, and this higher premium feeds back into the problem itself. This is convergence. It's not a prediction of immediate collapse. It's the identification of a potential inflection point. When the foundation of a system, in this case the Treasury market, begins to show simultaneous signs of structural pressure, the disciplined investor does not ignore it. They reassess risk. With the three signals established and the convergence identified, the next step is to structure scenarios. This is not about predicting the future with absolute precision. It is about mapping probabilities consistent with current mathematics. Scenario 1, controlled adjustment. In this scenario, nominal economic growth remains resilient. Tax revenue grows at a sufficient rate to offset some of the increase in the cost of debt. Congress implements some form of gradual fiscal discipline, either through spending cuts or increased revenue. The Federal Reserve manages to conduct monetary policy without losing inflationary credibility. And the term premium stabilizes. Result, long-term interest rates remain higher than in the previous decade, but the debt-to-GDP trajectory does not spiral out of control. Volatility decreases, and the market absorbs the new interest rate structure. This scenario is possible, but it depends on fiscal coordination and political stability, variables that are not purely economic. Scenario 2, partial monetization and structurally high inflation. Here growth slows, deficits increase, and political pressure on the Fed grows. The monetary authority may be indirectly forced to tolerate inflation above the target, to avoid an explosion in the real cost of debt. In this environment, adjustment occurs through erosion of purchasing power. The government pays the debt in nominal terms, but with currency of lower real value. The risk here is the gradual loss of credibility. The term premium may remain high because investors demand compensation against persistent inflation. This scenario does not imply immediate collapse, but it does imply a different structural risk regime. Scenario 3, stress event in the Treasury market. This is the most tense scenario. A combination of economic slowdown, widening deficits, and insufficient demand at auctions could generate significant volatility in the long-term yield curve. The market may demand higher yields quickly, spreads widen, liquidity deteriorates temporarily. The Fed may be forced to intervene to stabilize market functioning. This would not necessarily be a technical default. It would be a functional instability event in the asset that underlies global pricing. What makes 2026 relevant is the overlap between massive refinancing, possible cyclical slowdown, and increasing political pressure. None of these scenarios is inevitable, but all are consistent with the signals we discussed. Now we need to transform diagnosis into strategy. If the three signals we discussed indicate increased structural risk by 2026, the central question is, how does this change the way we build and protect wealth? First point, the traditional premise that long-term bonds always function as an automatic hedge against falling stock prices may not hold up in a fiscally dominant regime. During the last few decades, in virtually every economic slowdown, long-term interest rates fell. This raised the price of long-duration bonds and offset some of the losses in equities. But if the central problem is fiscal risk and not just economic cycle risk, long-term interest rates may remain high even in a slowdown environment. In that case, structural hedging weakens. Second point, duration ceases to be merely a defensive instrument and becomes a risk driver. The longer the maturity of the bond, the greater its sensitivity to yield variations. If the maturity premium continues to rise, long-term bonds may experience significant volatility, regardless of the short-term trajectory of the Federal Reserve's monetary policy. Third point, liquidity and credit quality become fundamental. In environments of fiscal instability, credit spreads can widen. Companies with weak balance sheets suffer more. Active selection gains relevance compared to indiscriminate passive exposure. Fourth point, real assets take on a strategic role. If part of the adjustment occurs via structurally higher inflation, assets linked to real flows, commodities, infrastructure, inflation-indexed assets can offer relative protection. Fifth point, short-term investments may offer a better risk-return ratio than long-term investments at certain points in the cycle. If the long end of the curve incorporates a high-risk premium, maintaining excessive exposure to long duration may not be asymmetrical. The most common mistake in regime transitions is extrapolating from the recent past. The nearly 4-decade period of structural interest rate decline has created a mental conditioning in the global investor. But regimes change. If we are migrating from a monetary dominant regime to a fiscal dominant regime, the portfolio architecture needs to reflect that transition. We've reached the end of the analysis, and ultimately everything converges on a single variable: confidence. The bond market doesn't operate on emotion, it operates on probability, cash flow, and institutional credibility. As long as investors trust the government's ability and willingness to stabilize its fiscal trajectory, the system works even with high levels of debt. But when the trajectory begins to suggest a loss of control, the adjustment occurs via risk premium. To summarize objectively, first we observe the unanchoring of the long end of the curve, reflecting an increase in the term premium and a structural shift in the demand for treasuries. Second, the debt service trajectory is accelerating as refinancing occurs at higher rates, putting pressure on the federal budget. Third, the dynamics of the yield curve, with deep inversion and potential for adverse steepening, create an environment historically associated with systemic tensions. By 2026, much of the debt issued in an ultra-low interest rate environment will have been refinanced. This will be the real test. At that point, the average cost will fully reflect the new monetary regime. If nominal growth is insufficient to offset the increased cost of financing, the debt-to-GDP ratio may enter an unfavorable dynamic, and if this occurs simultaneously with an economic slowdown, political pressure on the Federal Reserve tends to increase. The main risk is not necessarily an explicit default, it is functional instability in the market that underlies global pricing. Treasuries are not just securities, they are collateral for the international financial system, they are a benchmark for risk-free rates, they are a central instrument of liquidity. If confidence in the fiscal trajectory is questioned, even marginally, the impact spreads throughout the credit system. That is why the disciplined investor does not react when the problem is already in the headlines. He observes the mathematics before it becomes consensus. This isn't about panic. It's about strategic positioning in the face of increasing risk, asymmetry. If you want to continue analyzing these structural movements with technical depth and anticipation, subscribe to the channel and activate notifications. Because in the bond market, those who understand the yield curve understand the future, and those who understand the future protect their assets before most people realize what's happening.